This week, it's time for Security Money. The Security Weekly 25 Index comes roaring back. In our second segment, we welcome Jeff Pollard and Jess Byrne from Forrester Research to discuss the CISO's Guide to Microsoft Investments and how to pick your battles to avoid over-consolidation. Business Security Weekly starts now.
This is a Security Weekly production for security professionals by security professionals. Please visit securityweekly.com/subscribe to subscribe to all the shows on our network.
Broadcasting live, it's the show where we explore the business of security to improve the security of business. Your trusted source for actionable insights on leadership, communication, and innovation. Get ready for Business Security Weekly. Panoptica, Cisco's cloud application security solution, provides end-to-end lifecycle protection for cloud-native application environments. It empowers organizations to safeguard their APIs, serverless functions, containers, and Kubernetes environments. Panoptica ensures comprehensive cloud security, compliance, and monitoring at scale, offering deep visibility, contextual risk assessments, and actionable remediation insights for all your cloud assets. Get more information at securityweekly.com/Panoptica. Let's talk about something that's becoming increasingly important for enterprise companies worldwide, cyber risk management. Traditionally, cyber risk has been managed manually in silos, separate from the business's core operations. The future is about getting real-time risk insights benchmarked against your industry peers through automation. And CyberSaint's CyberStrong platform is leading the charge. CyberStrong is not just another point solution. It's a revolutionary platform. It's a quantified top-down risk approach where your unique cyber risks inform C-suite decision-making. If you're looking to elevate your cyber risk management program, CyberStrong is your answer. Download your free copy of Gartner's report on continuous controls monitoring by visiting securityweekly.com/CyberSaint. Welcome to Business Security Weekly. This is episode number 337, recorded February 5th, 2024. I am your host, Matt Alderman. Joining me for this show today are my co-hosts. First, Mr. Jason Albuquerque. Big Super Bowl this weekend, buddy.
It's Super Bowl week, my friend. Last I looked, I think 49ers were favored, but it's like 2.5. So, it's going to be close.
It's going to be a toss-up, I think.
Yeah, no doubt.
See.
If Mahomes is on, he's going to just tear it up like he normally does.
Yeah, right. I mean, you remember Baltimore creamed San Francisco at week like 14 or something like that. And so Kansas City beat them. So you never know. We'll see. Yeah.
It'll be exciting though. It'll be a good game.
Yes. We're going to have about 60 people here at the house. So wife's freaking out just a little bit.
I love the Super Bowl parties, man. They're fun.
Yep. Also joining for this segment, Mr. Ben Carr. Welcome, Ben.
Hey, Matt. How you doing today? The nice weather we're having here. A little bit of bounce back. Almost feels like spring. I'm excited about the Super Bowl as well. I'm sure Jason is just really watching for Taylor Swift, though. He wants to see how that's going to do.
Yeah, she does. She does have a beautiful mansion here in Rhode Island. So yeah, she has Rhode Island.
I knew it.
He's a Swiftie. Look out, folks. Don't let third-party risk ruin your Valentine's Day. Join Adrian Sanabria and Bill Brenner on an SC Media webcast titled Understanding Third-Party Risk by Studying Third-Party Breaches. As listeners will know, Adrian loves exploring risks through our understanding of real breaches and incidents. They'll discuss how to prepare for some of the most concerning third-party risks you should be aware of, along with our partner for this webcast, Process Unity. Visit securityweekly.com/Valentine Risk to register for the webcast. All right, gentlemen, it is time for Security Money. So as people know, I do this every quarter. But before we get in, I got to tell this little story. So we're in Mexico a couple weeks ago. And my family's all farmers, right? So my grandparents, my stepdad, like all farmers, right? So we're at the pool bar, and here's two Minnesota farmers. They're just chatting it up. They're talking about corn and soybeans and all this stuff. And so they're like an hour. They're just talking. And finally they look over at me and they go, "What do you do?" And I said one word. I go, cybersecurity. The first question out of their mouth was, who should we invest in?
Nice.
That's a way to keep it really simple. So who would you invest in? So it was interesting, Jason, as I was putting this one together, my father-in-law came over on Friday as I was finishing up the investments, and I was telling him the story, and he goes, so who was it? And I said, it's CrowdStrike. Like, this is CrowdStrike, right? I mean, it's got to be one of the best performing stocks. So I actually went through all 25 stocks. And since the time I started tracking them, I calculated their returns. Guess who was number one?
CrowdStrike.
CrowdStrike. Who's number two? Any guesses on number two?
Ooh.
I don't know. Who would be number two?
It's Zscaler.
Really?
Let me give you the percentages because I think this is really interesting. Remember, I started this index tracking back in July of 2018. So I got 5.5 years worth of data. CrowdStrike, 729% return in 5.5 years. Zscaler, 515%.
Wow.
As individual stocks. Yeah. It's pretty crazy.
That's amazing.
Palo Alto's up there. Palo Alto's like 384%, something like that. So there are a couple other ones, don't get me wrong, but those two far exceed all the other ones in the index.
Yeah, knocked it out of the park. That's amazing.
Yeah. All right. So where did we end up? Now, I didn't make any changes to the index this quarter because the Splunk Cisco acquisition hasn't closed yet. So Splunk is still trading on the open market. So no changes, but I will eventually have to figure out what I'm going to do with Splunk. And guys, look, we said this last quarter. I don't know that there's another replacement. This might become the Security Weekly 24 index. We'll talk about, there was one IPO. We'll talk about it here in a little bit because it was via a SPAC, and those don't have good track records. So
Nope.
So no changes. Index closed at 2221.82. It's 122% since I started tracking the index. NASDAQ closed at 15,628.95, which is 135%, 135.54. Now, the reason I said it came roaring back is if you look at the graphs that I posted in the show notes, what you're going to see is that the Security Weekly 25 index caught up. It narrowed the gap between it and the NASDAQ. Last quarter, we were over 60 percentage points away from each other. Now we're like 13%. So the index, when the market's doing well, accelerates really, really fast. It also decelerates. It decreases really, really fast.
Yeah. Right. Yeah. Yeah. And I know.
I mean, it's the volatility, right? So it just makes sense that you'd have that swing, upswing and downswing.
Yeah. Yeah. What I was going to say, I know we're going to talk about it a little bit later, but it's amazing to see the layoffs that are happening right now in line with this, right? January alone, there were 31,000, almost 32,000 layoffs. 122 technology companies, 32,000 people laid off. So just to kind of see that, how they're aligning, and it just shows you, are they trying to correct for some massive hirings that they did over the years, and they're trying to correct now.
Oh, they definitely are, Jason. There's no doubt about it. All of us in the industry are going through this. Like, every single company is looking at their head count, their cash burn, how much runway do they have left, and they're making adjustments. And you're seeing it on the profitability side too. Because when I get into some of the numbers, I mean, profit growth beats are going up by a big percentage, almost double what it was last quarter. And so part of the way you're doing that is you're cutting out costs.
That's it, 100%. And I mean, there have been some big layoffs in the industry. Like SAP, I think, was upward of 8,000 people. With the whole Broadcom VMware thing, I think it was like 3,000 people. So I mean, there's some big cuts happening.
Yeah, well, it was interesting. I saw Okta. It was only 7%, only about 400 people, so not huge, right? But the layoffs were, some of those layoffs were sales and SEs, right? And so it's interesting where they're laying it off too. I mean, if you analyze that.
Yep.
Yeah. Well, remember. I remember the sales team at Tenable as we were growing, getting ready for IPO. We were losing money on purpose to grow revenue, right? Because that's when you were in the mode back then. It was, revenue at all costs. It didn't matter. Well, everybody's had to right size from those adjustments.
Right.
Yeah. All right, so some quick results. Let's see. Revenue beat by 1.65% on average, which is up from last quarter. Profit beat by 27.47%. That's up from 15% on average, so almost double from last quarter. So back to cutting costs, kind of improving profit margins. On average, the industry's doing really, really well. Best performing was Splunk Rapid7 and Onespan. Worst performing was Akamai, NetScout, and Radware. So interesting. I mean, Splunk obviously got the boost from the Cisco acquisition and performed pretty well. With that, like I said, eventually they're going to come out of this index. So I'll probably stop tracking them.
And that's going to be, I mean, it's going to be interesting to see what goes down with Splunk, because, Splunk is really good for Cisco, but I think Cisco needs to convince the customer base now that they're good for the Splunk customers, right? I think it's on Cisco to show, and obviously they were positioning against Palo, right, and their whole Cortex platform. But yeah, it's going to be interesting to see this go down.
Well, Splunk's been challenged for a while, right? I mean, just the cost of the implementation and long-term accelerated costs. It's really hard when you're looking at a budget and you see that ever-increasing cost. I mean, it's been kind of on the bubble for a lot of people about thinking about what's the next technology in that space. So it'll be interesting to see what Cisco does with it.
Yeah, and look, people have been trying to displace Splunk for a while because of the cost structures, right? You have Graylog and a bunch of Devo all trying to go after the Splunk business. Even Snowflake is trying to go after the data lake to move data out of Splunk into the Snowflake security data lake. So you're seeing competition from a lot of different places.
We're gonna talk about it in the next segment. Look at Microsoft with Sentinel. Right.
Yeah, I had high hopes for Microsoft. I had high hopes for Google, right? I thought, like, Google, king of search, right? Like that is the epitome of a space that they should play hard in, and they kind of just step back from that. And so is Microsoft in a way. I mean, they're still touting Sentinel, but it's not where I thought it would be. So it's really a hard displacement right now.
Yeah, it is. A couple, let's see, average analyst ratings were 1.73, which is a moderate buy. That's pretty good for the industry. That is down a little bit, though, from some of my previous quarters, because I had to go back a couple quarters and look. Best rated is Fastly, CrowdStrike, CyberArk, and Tenable. Worst rated, Secureworks, which does not surprise me. They have not performed very well. I think their overall,
I mean, they've been consistent on that list.
Yeah. Even their return over the 5.5-year period, it's negative, guys. It's like almost negative 50%, right? QLYS is on the list, which actually surprised me. Now, QLYS, I think, gets beat up because of its revenue growth. But QLYS has been profitable from day one and has been very consistent when it comes to revenue reporting and profitability reporting. So to be the worst rated by the analysts, the only reason I could see that is because I think most analysts want to see QLYS's revenue grow faster, which it hasn't yet. And so
it's rate of growth that's holding them back, right?
I think so. Yeah. And then Onespan was on the worst rated list. I was also, with my father-in-law, I was kind of analyzing this. There's only one stock paying a dividend in this list of 25. And dividends are interesting, right? When you think about institutional investment play, people look for not only returns, but they also look at dividends. And it's surprising to me that only one out of the 25 stocks is actually providing a dividend in this list. And I could see companies that have had profitable consistency with profitability, putting themselves in a really interesting position to offer a dividend, which would make them a little stickier when it comes to institutional investments like retirement funds, et cetera. But I haven't seen that play out with these stocks yet.
No. Yeah, the Ubico that you called out was interesting, right? I'm not sure if, and again, I haven't driven into this a whole hell of a lot, and by no means am I an expert, but it was really interesting to go down this path and look look at special purpose acquisition companies and dig a little bit deeper, because I really never until now dug into SPACs. I think this is interesting, and it doesn't sound like it's something that is going to bring stability to Yubico. What are your thoughts on that?
Yeah, so SPACs are really interesting, right? And we've had a number of companies come out via this instrument into the market. And I was really surprised when I saw the headline, Yubico goes IPO. And I'm like, wait, did I miss that? And then as soon as you open the article, because Adrian covered it on ESW, and I'm like, oh, it was via SPAC. IronNet via a SPAC. IronNet no longer exists. ZeroFox via a SPAC has struggled with their stock price since coming out. I do not see this being positive for Yubico.
Yeah, and now the company, typically with the SPACs, it's a holding company that they use, right, to allow them to go public. And the company was from Sweden. It's ACQBR. I've never even heard of them. Do you know much about them, Matt?
I don't. Nope.
Yeah, so it's just an interesting model, but everything that I've dug into doesn't seem to lend to long-term viability of companies that go public in that manner.
No, it has. Track records have shown that that's not a great way to go. And so why not just wait for the markets to turn back around later this year? Because that's what everybody thinks is going to happen, right? It's not going to happen in March because we're not probably going to get any rate cuts in March, but maybe April, May, we do. The market starts to turn around. Does it become an IPO market again? Why don't you just wait? Maybe they needed the cash to keep going, which is usually the reason some of these do it.
Right.
But yeah, not a good track record.
No.
All right, couple other highlights. Broadcom completes its acquisition of Broadcom, and as part of that, Carbon Black breaks off from VMware. Now remember, when Carbon Black was acquired, it was put up under the VMware umbrella. They're splitting themselves or running as two separate businesses under Broadcom, which will be interesting to see how that plays out. I think Carbon Black has lost a lot of momentum compared to CrowdStrike and SentinelOne. So how well will they do on their own?
Big time. And I mean, it's such an interesting dynamic now, right? Because Broadcom acquires VMware. They split out Carbon Black and it's into its own standalone business unit. The folks at Carbon Black come out and say, this is going to be great. We're no longer going to be under the umbrella of VMware. We get to start setting our own path. But then you take a look back at in November when the CEO of Broadcom came out and they were talking about, the exploration of the acquisition and just talking about it. He literally came out and said, they're going to start consolidating and dropping underperforming operations, and specifically called out Carbon Black in that statement. So it's almost like it's set up to not continue on. And then you take a look at what else is in the portfolio. Symantec's in the portfolio, right? I mean, it's going to be interesting. That's right. That's right.
What this means is, so here's the tea leaves, right? Carbon Black's going to get sold off. Broadcom's going to divest itself of Carbon Black, probably. And the question is, who's going to pick it up, right? So you've seen this with other parts of the portfolio from other companies like McAfee, RSA, where they've been broken up. Pieces have been sold off. It's going to go down a very similar path, I think.
Yeah. How has that worked out for any of them, though? Like, that track record is on the board. People know how that works out, and it doesn't, in my mind, it doesn't work out well. So I don't think there's a very big future there.
Yeah.
No, because I don't know. I mean, okay, so STG buys, let's just play this out for a second because STG has been doing some of these maneuvers, right? So STG buys Carbon Black. What do they do with it? Like, do you bundle it with NetWitness? I don't know. Like, I mean, there's very few options for it, I think. That's going to be one of the challenges.
And if you're looking for a technology in this space, like there are defined market leaders out there, like why are you considering that? Like what's the advantage there? I'm not seeing there's not a technological leap that it's like, it's so much better. So what are you selling on cost? That's always a bad road down. I mean, I think it's just a challenging space for them.
Yeah, that technology is long in the tooth because remember, this is Carbon Black and Bit9 from way back. right? I don't think they've made a ton of innovation. You have CrowdStrike and SentinelOne out there, plus Windows Defender really making a lot of momentum, which we'll talk about in the next segment. Boy, the endpoint space has gotten a little tight.
Yeah, definitely.
It has, and there's stuff coming around the periphery of there. You have things like Halcyon, right, which are coming around the periphery of that are kind of filling in that space and offering capability that isn't in those three. So I mean, I think, yeah, it's a crowded space for someone to try to re-enter.
Mm-hmm. Yep. One last thing: IronNet ceases operations. No surprise, they've been struggling for quarters on end. They're just gone. Bye bye. All right, let's go to private funding. Still good funding rounds. I mean, there's still some, Island raises $100 million to keep that going. I worry about Island in the long term with a lot of the Google Chrome Enterprise stuff, but they got to keep raising money. There were some interesting acquisitions. Again, Palo Alto, very active. Talon Cyber for $625 million and Dig Security for $400 million. I mean, Palo just keeps buying, guys.
Mm-hmm.
Big war chest.
Yep.
Yeah. Zyston acquires what was left of Blue Lava. Right? I said Blue Lava kind of went away last quarter. Some of the assets were picked up by Zyston. The biggest news, I'm so happy about this too. Singtel decides to sell its stake in TrustWave, losing only about $450 million.
It's a write-off.
You guys know my first startup was acquired by TrustWave, right? So there is no love lost between me and TrustWave. Couldn't have happened to a bunch of nicer guys.
There you go. Karma.
Exactly. I don't know if there were any in here you guys wanted to cover a little more specifically. There's a pretty long list of raises.
Yeah. I mean, from an acquisition side, I mean, Blue Voyant starting to make some moves. I know them from the services space and the SOC space, but yeah, they've been moving pretty fast, and they've been out there, and to see this doesn't surprise me, but I think they're on a pretty good path.
Yeah, Okta made a couple acquisitions too this last quarter, Spira and Uno, right? So Okta, as a public company, has a war chest. They're putting some of those dollars to use as well.
Nope.
Yeah, and they, and I mentioned earlier that Okta went through the layoff, right? So I mean, it's obvious that they're trying to trim operating expense, but trying to expand, where they can sell into too. So I mean, that was interesting to see that.
Yeah, definitely.
And then the surprise for me was Nord Security being able to raise $100 million. I mean, I knew they could raise some money, but $100 million. Whew, hello.
Yeah, there's still good money out there, right? I mean, Halcyon for 40, Adlumin for 70, Census 75. I mean, there's money out there. I mean, people are still willing to invest in the market and move things forward. So I think that there's signs are it is looking better into 24.
It is. It was interesting when I was going through polling the articles from Enterprise Security Weekly. I started December and worked my way back. And as I was going, I was like, boy, there's not a lot of funding announcements, not a lot. And then all of a sudden I got to October and I was like, boom. I'm like, oh, there they all are, right? They were all in the first part of Q4. They were all in that October timeframe before the holidays. All these big announcements of funding. And Ben, to your point, right? There is money available. The question is valuations for that money. And, are you in the right position to raise at a decent multiple right now, right? I think that's the big key.
Yeah, I don't think the capital, the powder ever went away. I think it was always available out there in the market. I think the challenge was the valuations had gotten reset, and there were a lot of founders that had unrealistic expectations and were still trying to hold on to that. So I think it took some time for that kind of shift to happen in the normalization where people realize, okay, I'm not going to go for 150. I'm going to ask for 60, right? And so as a result of that, now you're seeing more things start to pop and happen. and people start to expend that powder and make investment decisions. So I think it's a good, like I said, it's good signs for the market in 24.
Yeah, just to talk about that powder, right? That dry powder. Last number I saw was something close to $6 trillion sitting on the sidelines out of the market right now. There's definitely money out there, guys. Yeah. Definitely money out there.
Yeah, so when that breaks loose, imagine what that will do, right? So, I mean, I think, combined, if we see, there's been talk of the Fed, actually lowering rates. If we see that happen, I think you'll see a lot of changes ripple through.
Yeah, and I think that's what everybody's hoping for, right? I think they were thinking March. I don't think it's going to be March. I think it's going to be April, May timeframe before we see that first rate cut. It's all going to be based on the inflation numbers, right? But when it starts, I think you're going to see the market open up pretty quickly.
Yeah. What do you think that's going to do to the diligence process? I mean, we talked about it when we had Herjavec on here, right? About how organizations are under more scrutiny, looking at things like EBITDA, profitability as something that's extremely important, and doing a huge level of diligence on that. Do you think things are going to start loosening up to where they were, or do you think that diligence is going to continue?
Now, diligence will continue until we see money almost back to zero.
Yeah.
And I don't think we're going to see that for a while, guys. Yeah. I think we'll see 3, maybe 4 rate cuts this year. So we'll get down around 4.5% maybe. Yep. That's still that's from what we've seen over the last 12, 13, 14 years. That's still pretty high, right? So I think the due diligence stays in place. It's going to be a balance of revenue growth and profitability, Jason, that are still going to drive those numbers in the near term, because I don't know that we go back to like this almost free money scenario for a long time, right? We may never get back there. Who knows?
Yeah.
Yeah, but I think that's a positive, right? I mean, I think some increased diligence is necessary, right? So you're seeing increased scrutiny on spending, operating expense, what actual sales penetration there is, and how the market's responding to, product releases. So as that becomes more of the norm, I think we're going to see better companies emerge out of that in the long term.
Absolutely. And we're going to continue to see some consolidation for companies that can't make that cut either.
Yeah.
Right? Which is good. And you're seeing it, right? Palo's buying some, Okta's buying some. You're going to continue to see these acquisitions to continue to enhance and consolidate the market, right?
And from an operator side, I think that's a positive thing too, right? We're going to get better product out of it, but we're also going to get less, numbers, right? We won't have, 18 vendors we have to figure out what the heck's going on. We can focus on vendors that are actually serious in the market. We'll be able to make better representation decisions for how they will be useful in the environment that we're actually managing. So I think from an operator side, this is all good signs.
Yeah, which is a great segue into our next segment on Microsoft. So let's take a quick break and then welcome Jeff Pollard and Jeff Spurn from Forrester Research to discuss the CISO's guide to Microsoft investments.